Welcome to this explainer. Today, we're going to untangle what's honestly one of the messiest, most misunderstood topics in modern business right now. We're talking about billions of dollars on the line and narratives flying in literally every direction. So we're taking the manager's seat to build a highly practical BS detector for corporate sustainability claims. By the end of this, you're going to know exactly how to separate genuine strategic moves from empty PR, using a specific framework that will completely change how you read the news.
Okay, let's kick things off by looking at a really massive contradiction unfolding in the business world right now. If you've been reading the financial press lately, you might have some severe whiplash. Depending on the day, you could reasonably conclude that corporate sustainability is just entirely dead and buried. But the truth? It's actually a lot more complex than that, and frankly, a lot more fascinating.
You see, we're getting these super loud headlines about major brands walking back their commitments. You've got Walmart falling off track for its emissions targets, HSBC pushing its net zero goal back by 20 years, and Tractor Supply just dropping its net zero goal altogether. But the quiet reality on the ground tells a totally different story. Factories still have to pay soaring energy bills, global supply chains are heavily exposed to physical climate risks, and companies absolutely still have to answer to increasingly strict regulators. And the data totally backs this up. When researchers looked at corporate action heading into 2025, only 13% of firms had actually retreated from their sustainability efforts. A massive 85% held course or even accelerated their commitments. So if the vast majority of firms are still actively doing the work behind the scenes, why does it feel like everyone is backing away in public? Well, it all comes down to this really interesting phenomenon called green hushing. Basically, companies are caught in a massive crossfire. On one side, they face intense anti-ESG political backlash, especially in the US. But on the other side, they face strict pro-sustainability regulators and activist consumers in places like the EU. Because of this squeeze, about 31% of companies are now just putting their heads down and doing the work quietly so they don't get yelled at by either side. They've stopped issuing the flashy press releases just to avoid becoming a target.
Moving on to Section 1, Decoding the Corporate Jargon. To truly understand this recalibration, we first need to untangle the messy vocabulary businesses use.
First up, sustainability. People often assume this just means saving the environment or hugging trees, but it really doesn't. From a sharp manager's perspective, this is strictly about creating lasting value without using up the social and natural capital a firm relies on. It's the whole holistic effort a firm makes to survive and thrive long-term. Think about it. If a fast fashion brand runs out of clean water to dye its fabrics, or a tech giant alienates its entire engineering workforce, its business model simply isn't sustainable.
Next is the triple bottom line. This is an idea that gained serious traction in the late 90s, driven by growing global awareness of what mass globalization was actually doing. It shifts the focus away from just purely evaluating shareholder returns, the traditional profit bottom line, to balancing multiple core obligations. Simply put, you judge the firm on people, planet, and profit simultaneously.
Which brings us right to ESG, environmental, social, and governance. This brilliantly illustrates how abstract ideals get turned into hard data. ESG is the measurable version of a firm's sustainability efforts. We're talking carbon tons emitted for environmental, or board diversity metrics for governance. These are the tangible numbers that regulators, institutional investors, and rating agencies can actually track on a spreadsheet to hold leadership accountable.
Okay, Section 2, Value, Cost, or Theater. Now let's get to the mental model we'll use to judge every single corporate announcement moving forward.
The absolute most crucial thing here is figuring out exactly why a company is making a specific move, and we do that using a three-part lens. First, we have value. This is when an action genuinely makes the firm better off. It cuts costs, opens new markets, or significantly lowers long-term risks. Second is cost. This is a burden the firm just has to bear, usually for compliance or legal reasons, spending owners' money without any near-term financial return. And third, theater. This is purely symbolic action decoupled from actual practice. It's greenwashing, plain and simple, just for cheap reputation points. To see how this actually plays out over time, let's look at a single company bouncing between these motivations over a 25-year period. Look at BP. Back in 2000, they did this whole Beyond Petroleum rebrand with a shiny new green logo, while their core business was still massively invested in oil extraction. That was pure, unadulterated theater. Fast forward to 2020, they pledged net zero by 2050 and promised to heavily boost renewables. That was a genuine strategic bet on value. But by 2025, facing weak market returns and intense investor pressure, they hit a strategy reset and slashed their renewable spend. They realized that in the short term, that transition was actually a heavy cost. One single firm, 3 decades, 3 totally different underlying motivations.
But here's the catch. Even when a company genuinely transforms for value, shifting markets and politics don't guarantee a permanent payoff. Take the Danish utility company Ørsted. They did exactly what you're supposed to do. They fundamentally transformed their core business from a coal-heavy polluter into the world's largest offshore wind developer, a pure value play. But then, high interest rates and massive supply chain issues hit the sector, and Ørsted's stock ended up dropping roughly 85% from its peak. So, value is very real, but it is certainly not unconditional. Moving to Section 3, spotting corporate greenwashing. Since theater can eventually turn into a massive financial liability when customers and regulators catch on, we need to know exactly how to spot it. We call this the grammar of greenwashing. These are the red flags that tell us a company's PR is running way ahead of its actual internal actions. Look out for distant 2050 pledges with absolutely zero interim milestones. If the current CEO is going to retire decades before the pledge is due, that's a huge red flag. Watch for selective disclosure, where a brand trumpets one tiny green product line but stays dead silent about their massively polluting core business. Beware of vague labels like eco or natural that have literally no legal definition. And the biggest red flag of all, the say-do gap. That's when a firm publicly supports a climate goal, but quietly funnels millions to lobbyists fighting against those exact same regulations. All right, Section 4, judging real corporate moves. It is time to test your new BS detector by applying this framework to some rapid-fire, real-world scenarios. First scenario, imagine a massive big box retailer decides to roll out a nationwide efficiency upgrade for lighting and refrigeration across hundreds of stores. Think about the immediate financial impact of this operational change from the manager's perspective. What do you think? Value, cost, or theater? If you guessed value, you hit the nail right on the head. This is a classic bulletproof business case. Sure, there's an upfront capital expense to buy the new LED lights and modern fridges, but it directly cuts operational costs month over month. It makes the firm measurably better off. It's a win for the planet and a highly measurable, immediate win for the bottom line. Okay, scenario 2. An oil major launches a massive, glossy public relations campaign announcing a 2050 net zero pledge. But a closer look at their financials reveals they have absolutely no interim plan and haven't altered their capital expenditure for the next 5 years. Value, cost, or theater? Notice the massive gap between the timeline of the promise and the reality of the current leadership. You guessed it, that is pure theater. It's totally symbolic action decoupled from actual practice. The company is trying to buy cheap, short-term reputation points with a distant promise, while actually taking on huge long-term risks for when regulators inevitably step in and start handing out fines for deceptive marketing. Now for a slightly trickier scenario for our final test. A mid-sized company spends hundreds of hours and thousands of dollars filing mandatory EU CSRD sustainability reports to comply with new regulations. Value, cost, or theater? Consider whether this inherently generates new revenue right now, or if it's simply a legal requirement. The honest truth? Right now, this is purely a cost. It's a compliance burden borne by the firm with no immediate near-term financial return. It's basically a toll they have to pay just to keep operating in the European market. Now, sure, a really smart manager might eventually use that data to find future value, maybe by discovering hidden supply chain inefficiencies. But the act of reporting itself, that's just a cost. So, wrapping this all up, what are we actually witnessing right now? It's definitely not the death of corporate sustainability. It's actually a ruthless, highly practical recalibration. The era of cheap announcements is ending. Moving forward, what survives within these massive companies has to be heavily justified, either as a strict compliance cost just to keep the lights on, or a genuine driver of long-term strategic value. So next time you see a flashy corporate green announcement pop up on your feed, look past the green leaves and the eco-friendly fonts. Ask yourself, is this true value that makes the business fundamentally stronger, a begrudging cost they were legally forced to pay, or just a well-rehearsed piece of corporate theater? Looking at the brands you buy from every single day, when do you think sustainability is actually worth it for a firm? Keep your BS detector sharp, and thanks for joining me on this explainer.